Today, we're talking about a group that's increasingly showing up in small and mid-sized business deals, but often stays behind the scenes: family offices. Specifically, the role they can play in capital raises and in full or partial exits. If you're a founder, a CEO, or even an advisor in the lower middle market, this topic matters because family offices don't behave exactly like private equity funds, and they don't behave like banks. They sit in this interesting middle space.
And if you've ever heard family office and thought, okay, that's just a wealthy family investing, that's not wrong, but it's incomplete. The big question is how they actually show up in real transactions. Are they minority investors? Are they buyers? Are they lenders? Are they helpful long-term partners? Or are they unpredictable because it's all personal preferences?
Let's start by grounding the definition. A family office is typically an investment organization, managing wealth for one family or a small number of families. Some are very institutional with investment teams, operating partners, and a clear process. Others are leaner, more relationship-driven, and may move faster or slower, depending on who has conviction.
And that variety is the first lesson for anyone raising capital. People try to pitch family offices as if it's one bucket. It's not. You've got families who want control, families who only do minority, families who want cash-flowing businesses, families who want growth, and families who basically want to be hands-off as long as the reporting is clean.
So, let's break the conversation into two big chapters. First, family offices and capital raises for small and mid-sized businesses. Second, family offices and exits, meaning they can either buy the business outright by a majority stake or participate in structured partial exits like recapitalizations.
Perfect. Starting with capital raises. Why would a founder consider a family office investor versus, say, traditional private equity or venture?
A big reason is alignment around time horizon. Many family offices don't have a fixed fund life. Private equity funds often operate with an expectation that they'll exit within a defined window. Family offices might be comfortable holding an asset longer, compounding over time, and that could be huge for owners who don't want to pressure flip it in 5 years.
But it's not automatically patient capital. Some families are very return-driven and will push. It's just that the structure can allow patience if that's the shared goal.
Right? It's a possibility, not a guarantee. Another reason is flexibility. A bank typically wants a certain leverage profile and covenants. A fund might want a preferred return structure or specific governance rights. A family office can sometimes tailor something that fits the business: common equity, preferred equity, mezzanine-style structures, seller notes, or combinations.
And for the founder, the use cases are pretty broad. You might raise capital to expand, build a new facility, acquire a competitor, buy out a partner, or just strengthen the balance sheet. Family offices can participate in all of those, especially in that zone where the business is established but not large enough to attract giant institutional checks.
Let's talk about minority growth equity, because it's one of the most common ways family offices enter SMB deals. Suppose you've got a profitable company doing, say, 5 to 20 million in EBITDA, and you want to fund growth without selling control. A family office might invest for a meaningful minority stake with certain protections: board seat, information rights, vetoes on major decisions, but still leave day-to-day control with the founder.
And that can be appealing to founders who want to keep steering the ship. But here's the subtle risk: governance mismatches. Some founders think minority investment means I take the money and keep doing what I do, and then they're surprised when the investor wants monthly reporting, budget discipline, or a say in leadership hires.
Exactly. And family offices differ wildly in how involved they want to be. Some want to contribute operating expertise. Some want zero involvement. The key is to clarify involvement up front and put it into the deal terms, not just verbal expectations.
Let's shift to another capital raise use case: structured capital for acquisitions. Family offices can be excellent partners for buy and build strategies, especially where the company is too small for the mega funds but has a clear consolidation path.
Yes, and in those situations, the family office may underwrite the platform and bankroll add-ons, or they might co-invest alongside a sponsor. That's another role. Family offices as co-investors. Many family offices like to invest alongside private equity firms, especially if they trust the sponsor's sourcing and diligence capabilities.
That's a big point. If you're a founder, you might not even realize a family office is in your cap table because they came in as a co-investor behind the lead sponsor.
Now, before we move to exits, let's cover a practical question. How do you actually get in front of family offices for a raise? Because people assume it's just cold emails to family office lists, and that's usually not effective.
Warm intros are everything. The most common routes are through investment banks, brokers, wealth managers, attorneys with transactional practices, accountants, and sometimes through other business owners. But also, some family offices have become more visible. They have websites, stated criteria, or even dedicated teams that run inbound funnels.
But you still have to be ready for a different kind of diligence. Some family offices are institutional and will run a full process similar to PE. Others will focus heavily on the founder, the culture, and the story. And because it's a family's capital, sometimes you're not just selling the deal, you're building trust with the decision makers.
Which can be refreshing or frustrating. Refreshing because it can feel more human. Frustrating because the decision chain can be unclear. Sometimes it's a CIO. Sometimes it's a family principal. Sometimes it's the family council that meets quarterly. And that can impact timing.
Okay, let's move to exits, because this is where many owners hear about family offices as a buyer, but the reality is more nuanced. They can play several roles. They can be the acquirer. They can be a majority investor in a recap, or they can fund management buyouts and partner transitions.
Let's start with the cleanest version. Full exit. A family office buys 100% of the business, founder walks away, maybe stays on for a transition, and that's that. When does that happen?
It often happens when the family office wants a long-term operating asset, something stable, understandable, and cash generative. Think essential services, niche manufacturing, business services with recurring revenue, distribution, certain healthcare services. Areas where a family can hold for a long time and not need to sell quickly.
And many family offices like the idea of being a forever owner. That phrase comes up a lot. They might not lever the business as aggressively, they might invest steadily, and they might care about employee retention and brand reputation because it's tied to the family name.
But founders should be careful with the word forever. Even if the intent is long-term, circumstances change. Family dynamics change. Leadership changes. Liquidity needs change. So rather than relying on a slogan, you want structure. What happens if they want to sell? What governance exists? What protections exist for management? And what's the plan for reinvestment?
Now the second exit pattern is the partial exit, which is hugely important in the lower middle market. A founder sells, say, 60% or 70% to a family office and keeps 30% or 40%, stays on to grow the business, and then has a second bite later.
That can be a great outcome. It de-risks the founder personally, gets liquidity off the table, while still keeping them motivated and aligned with future upside. Family offices can be good partners here, because they may be open to patient growth and not force an exit on a strict clock.
But the tricky part is control and decision-making. If you're selling majority, you need clarity on what autonomy management retains. Are budgets approved by the board? Who hires and fires the CEO? What happens if the founder wants to step back in 2 years? And what if performance dips? Does the investor have step-in rights?
And then there's a recapitalization variant, where the founder takes chips off the table, but the company also raises growth capital. This can look like a dividend recap, though family offices often do it more conservatively, or it could be primary capital into the business plus secondary liquidity to the owner.
There's also a third scenario that doesn't get talked about enough: partner buyouts and generational transitions. Sometimes a family office provides capital so a next-gen leader or an internal executive team can buy out an aging founder. That's not a flashy headline, but it's a very real need.
Yes, especially in businesses where the owner wants to protect culture and employees. If the alternative is selling to a strategic that might consolidate and cut, a family office-backed management transition can feel like the best of both worlds. Liquidity for the owner, continuity for the team.
Let's talk expectations on pricing and terms. Do family offices pay market in exits?
Some do, some don't. In competitive processes, they often have to, but certain family offices look for proprietary deals where they can win on certainty, reputation, or speed rather than topping the highest multiple. Also, because they can hold longer, they might underwrite value differently. But founders shouldn't assume a family office automatically pays more or accepts looser terms.
In fact, sometimes they're more conservative because it's their capital. They may care a lot about downside protection, clean accounting, and predictable cash flow.
Which brings us to what family offices typically want to see in a deal, whether to raise or an exit. They want understandable economics, strong unit economics or margins, not just excitement. They want proof of demand. They want a management team that isn't completely dependent on the owner. And they want clean reporting, sometimes not perfect, but improving and transparent.
And they want to trust you. I know that sounds fuzzy, but in family office deals, trust can be central. If the owner is evasive about a customer concentration issue or a lawsuit, that's a quick no. If the owner is upfront and has a plan, it can still be financeable.
Now, we should talk about the challenges. Family offices can be wonderful partners, but there are real friction points. 1. Variability and sophistication. If you're used to deal with an institutional investor, a less institutional family office might struggle with process speed or clarity.
2. Decision-making opacity. You might build a great relationship with the investment professional, then learn the final decision rests with a family principal who has different priorities. Or a non-investment family member weighs in late.
3. Concentration risk on their side. A PE fund might need to deploy capital. It's their business model. A family office may decide, suddenly, that they're heavy in one sector and they're done allocating there. Or they have a liquidity event somewhere else and pull back.
And 4. Misaligned expectations around involvement. Some family offices want operating influence but don't have the infrastructure to provide it effectively. Others say they're hands-off but become much more active after closing.
So what are best practices if you're a founder considering family office capital? I'd say first, segment them. Don't pitch every family office. Identify the ones aligned with your sector, check size, and preferred deal structure, minority, majority, control buyouts, hold period, geography.
Second, ask direct questions early. What's your typical check size? How many deals have you done? Who makes the final call? What's your timeline? What does reporting look like post-close? What rights do you require? Get clarity before you spend months.
Third, be explicit about your own goals. Are you trying to keep control? Are you seeking liquidity now or later? Do you want a partner who can help recruit executives? Do you want a long-term hold or a planned second exit? When founders are vague, they attract mismatched capital.
Fourth, think about the future transaction today. Even if the family office says, we can hold forever, you should discuss what happens if you want to sell in 5 years, or if you want to buy back shares, or if you want to bring on debt. Align on those pathways upfront.
And I'll add one more. Don't underestimate the value of an advisor who understands this ecosystem. An investment banker, a strong M&A attorney, or an experienced CFO can help translate expectations, avoid term traps, and run a process that keeps leverage on your side.
Let's make this concrete with a quick hypothetical. Say you run a regional field services business. You're profitable, growing steadily, and you want to buy 2 competitors. A bank will lend, but only up to a point. A family office might provide equity to keep leverage reasonable, help you close the acquisitions faster, and allow you to stay CEO with meaningful ownership.
Or another scenario. You're a founder who wants to de-risk but not retire. A family office buys 70%, you take liquidity, you keep 30%, and run the business for the next chapter. Then, in a few years, you either sell the rest or roll into a larger platform transaction. That's not just theory. Those deals happen all the time.
And the reason family offices fit here is they can be flexible about structure. They're not always the best fit, but when it matches, it's powerful.
So the takeaway, family offices are not a monolith. They can function as growth capital partners, control buyers, co-investors, or transition financiers. For small and mid-sized businesses, they can bring patient capital, flexible structures, and sometimes a values-aligned approach. But you have to do your homework, ask blunt questions, and set the rules of the partnership on paper.
If you're an owner thinking about a capital raise or an exit, here's a simple question to ask yourself. Do I want the best price, the best partner, or the best certainty? Sometimes you can get all three, but usually you're trading one against another. Family offices often win on partnership and certainty, and sometimes on price, depending on the situation.
That's it for today. Next time you hear family office, don't just think rich family. Think about what kind of capital they're offering, what kind of relationship they want, and what that means for your business 5 years from now.